Something extraordinary is happening in the precious metals market right now. And if you're only watching gold, you're missing the biggest story of 2025. Silver just did something it hasn't done in over a decade. While gold climbed to record highs above $43 and almost $100 per ounce, silver didn't just follow along. It exploded. Year-to-date gains of 131%, nearly double gold's already impressive 65% rise, and crushing the S&P 500's returns by a factor of more than 10. But here's what should make you pay attention. This isn't just about percentage gains. This is about a fundamental shift in market dynamics that's been building for years. A shift that most analysts completely missed until it was already underway. And a pattern that history shows precedes the most explosive moves in silver's price. The gold to silver ratio, the number that tells you how many ounces of silver equal 1 ounce of gold. For most of 2024, that ratio sat stubbornly above 80 to 1. In some months, it spiked above 100. That meant you needed more than 100 ounces of silver to buy a single ounce of gold. Silver was cheap, historically cheap. Cheap in a way that only happened a handful of times in the last century. And every single time the ratio reached those levels, the same thing happened. Silver rallied hard. In 1991, the ratio broke above 80. Silver surged in the years that followed. In 2002, the ratio hit that level again. Silver responded with a multi-year rally. In 2009, during the financial crisis, the ratio spiked above 80. What followed was one of silver's most dramatic modern rallies, from $9 to over $48 per ounce in less than 3 years. A 391% gain. In 2020, the ratio hit an all-time high of 125 to 1 during the COVID panic. Silver crashed as gold soared. But within months, silver staged an epic comeback as the ratio compressed back down. The pattern is undeniable. When the ratio exceeds 80, silver is undervalued relative to gold. And when that imbalance corrects, silver doesn't just catch up, it explodes. Right now, as of December 2025, the ratio sits near 64 to 1. Down from over 100 just months ago. That's a massive compression. And if you understand what that means, you understand why this is just the beginning. Let me show you exactly what's driving this move. Why the fundamentals behind silver's rally are stronger than anything we've seen in decades. What the historical pattern tells us happens next. And why the people who understand this pattern are positioning right now, not waiting for confirmation. The gold to silver ratio is one of the oldest continuously tracked financial metrics in history. Over 5,000 years of data. And for most of that time, the ratio averaged somewhere between 15 to 1 and 60 to 1. In ancient Rome, the ratio was fixed by law at 12 to 1. During the bimetallic standard in America in the 1800s, the government maintained it at 15 to 1. But after governments abandoned fixed exchange rates for precious metals, the ratio started floating based on market forces. And that's when the volatility began. Through the 1980s and 1990s, the ratio typically ranged between 40 to 1 and 60 to 1. Occasionally, it would stretch to the upper 70s during economic stress, but 80 to 1 was rare. It marked extremes. The modern era, particularly the 21st century, has seen unprecedented volatility. The ratio reached 84 to 1 during the 2008 financial crisis. It hit 80 again in 2002, and then came March 2020. As COVID lockdowns spread globally, the ratio spiked to 126 to 1, the highest recorded level in history. Investors fled to gold as the ultimate safe haven. Silver, with its substantial industrial demand, got crushed as factories shut down and economic activity froze. But here's what's critical to understand. Every time the ratio has exceeded 80 to 1 in the past 50 years, it eventually reverted toward the historical average. Not immediately. Sometimes it took months or even years. But the reversion always happened. Because the ratio measures relative value. And when one metal gets too expensive relative to the other, market forces eventually correct the imbalance. The compression from 126 to 1 in March 2020 down to 64 to 1 today represents a fundamental repricing. And if history holds, we're not done. The 25-year historical average for the ratio is approximately 66 to 1. We're there now. But during precious metal bull markets, the ratio doesn't just hit average, it overshoots. In 1980, the ratio fell to 17 to 1 as silver surged to nearly $50 while gold hit $850. In 2011, during silver's last major rally, the ratio compressed to around 31 to 1. If the ratio moves to 50 to 1, with gold at current levels near $4,300, silver hits $86 per ounce. If it compresses to 35 to 1, matching the 2011 cycle low, silver hits $122. And if it reaches the natural abundance ratio in Earth's crust, around 17 to 1, silver tops $250 per ounce. These aren't wild predictions. These are mathematical outcomes based on historical precedent. The question isn't whether the ratio can compress further. The question is how far and how fast. And to answer that, you need to understand what's different about 2025. Silver has a dual personality. It's a monetary metal like gold, held as a store of value and hedge against currency debasement. But unlike gold, which is almost exclusively a financial asset, silver is an industrial workhorse. About 60% of silver demand now comes from industry. That's up from 40% just a decade ago. And that's the key to understanding why this rally is different. Gold's industrial use is minimal, maybe 10% of total demand. When economies slow, gold holds up because investors buy it as protection. Silver should theoretically get hit harder because industrial demand falls. That's the conventional wisdom. And it's why silver crashed harder than gold in March 2020. But something changed. The world didn't just recover from COVID. It accelerated into the biggest technological and energy transition in a century. And silver sits at the center of that transition. Solar panels, the fastest growing source of silver demand. Photovoltaic technology now accounts for 29% of total industrial silver demand. That's up from just 11% in 2014. Each solar panel requires approximately 20 grams of silver in conductive pastes. Silver's unmatched electrical conductivity makes it irreplaceable for converting sunlight into electricity efficiently. Global solar capacity has exploded. In 2024, solar installations broke records globally, and they're accelerating. The European Union has set a target of 700 gigawatts of solar capacity by 2030. That's more than double current levels. China, already the world's largest solar market, continues expanding rapidly. The International Energy Agency expects that new solar capacity added between now and 2030 will account for more than 80% of growth in renewable power globally. And here's the kicker. Newer solar panel technologies actually use more silver per panel, not less. The industry had been working to reduce silver content per cell through a process called thrifting. In 2009, each solar cell required 521 milligrams of silver. By 2024, that had dropped to around 111 milligrams. But next-generation technologies like tunnel oxide, passivated contact panels, known as TOPCon, and silicon heterojunction panels, require substantially more silver. These newer panels are more efficient, which makes them economically attractive despite higher silver content. And they're becoming the industry standard. The Silver Institute projects that silver demand from photovoltaics jumped over 25% in 2024, reaching an estimated 230 million ounces. By 2030, demand from solar alone could exceed 300 million ounces annually. That would make solar the single largest industrial user of silver, consuming nearly a third of total mine production. Electric vehicles. The automotive revolution is another massive demand driver. Battery electric vehicles use between 25 and 50 grams of silver per vehicle. That's 67 to 79% more than internal combustion engine vehicles. Silver is critical in battery management systems, power electronics, charging infrastructure, and electrical contacts. As automakers commit to electrification, silver demand from this sector is accelerating. The Silver Institute forecasts global automotive silver demand will increase at a compound annual growth rate of 3.4% between 2025 and 2031. That doesn't sound dramatic until you realize how many vehicles are being produced. By 2031, electric vehicles are projected to account for 59% of total automotive silver demand. And breakthroughs like Samsung's silver carbon composite anode for solid-state batteries could push silver usage to 1 kilogram per battery pack in future EVs. That's 20 times current levels per vehicle. Artificial intelligence and data centers. This is the demand driver almost nobody is talking about. As AI adoption accelerates, so does demand for the physical infrastructure to support it. Data centers powering AI models, cloud computing, and digital services require massive amounts of computing hardware, and that hardware depends on silver. The Silver Institute estimates that total global IT power capacity increased by approximately 53 times from 2000 to 2025, from 0.93 gigawatts to nearly 50 gigawatts. That's a 5,252% increase in IT power demand. More computing power means more servers, more GPUs, more tensor processing units, all of which use silver in internal connections, packaging, and thermal management systems. Silver's thermal conductivity is better than copper, aluminum, or bronze. That prevents overheating in high-performance processors. As AI companies expand data center capacity to meet surging demand, silver consumption in this sector is expected to double by 2030. And governments worldwide are prioritizing data centers as critical infrastructure, providing grants, tax breaks, and fast-track approvals. This isn't speculative future demand. This is infrastructure being built right now. Electronics, medical devices, 5G infrastructure, advanced manufacturing. Every sector of the modern economy is increasing silver consumption. Industrial demand hit a record high in 2024, and the Silver Institute projects it will keep growing through 2030. This is the dual engine powering silver. Investment demand provides the monetary floor, Industrial demand provides the structural growth driver. When both engines fire at the same time, silver doesn't just rise, it launches. But explosive demand means nothing if supply can meet it, and that's where the real crisis is building. The silver market has been in a structural supply deficit for 5 consecutive years, from 2021 through 2025. That means more silver was consumed than was produced every single year. The cumulative deficit approaching 820 million ounces. That's roughly equivalent to an entire year of global mine supply. Gone. Drawn down from above ground inventories. In 2025 alone, the deficit is projected at 117 million ounces. That's the 5th year in a row. And the deficit is expected to continue into 2026 and beyond. This isn't a temporary imbalance, this is structural. Why can't miners just produce more silver? Because silver supply is fundamentally different from gold. About 70 to 80% of silver production comes as a byproduct of mining for other metals: copper, lead, zinc, and gold. That means silver supply doesn't respond directly to silver prices. Even if silver prices double, production doesn't immediately increase because miners aren't digging for silver. They're digging for copper or zinc. And if copper prices are weak, they're not opening new mines, even if silver prices are strong. Primary silver mines, the ones actually targeting silver, account for only about 20% of global production. And those mines aren't expanding. For Nilo, the world's largest primary silver producer, cut production guidance for 2025 by 8% due to declining ore grades. Pan American Silver delayed expansion projects. Every major primary producer is in the same position. Declining grades, delayed projects, reduced output. Bringing new mines online takes a decade or more. Permitting, financing, development. Even if companies started aggressive exploration today, new supply wouldn't hit the market until the 2030s. And they're not starting, because developing a mine costs hundreds of millions or billions of dollars, and there's no guarantee silver prices will stay high enough to justify the investment. Recycling can't fill the gap either. The Silver Institute reports recycling rates for electronics at just 18%. That means 82% of silver used in devices never gets recovered. Why? Because extracting 0.03 grams of silver from a phone isn't economical. Solar panels are even worse. They lock silver away for 25 to 30 years. And when panels reach end of life, most get landfilled instead of recycled because recycling is expensive. That silver is gone for decades. The math doesn't work. Mine production is flat at best, declining in many cases. Recycling adds maybe 150 million ounces annually. Total supply around 960 million ounces, but total consumption in 2024 topped 1.2 billion ounces. That 240 million ounce gap has to come from somewhere, and it's coming from inventories. Exchange inventories have fallen to multi-year lows. Registered silver at the COMEX, the silver available for delivery against futures contracts, has been declining. When inventories fall, markets become sensitive to even small disruptions. Delivery delays increase, premiums for physical metal rise, and anyone who needs actual silver, not paper promises, starts paying up. Lease rates for silver spiked to 30% annualized in October 2025. That means people were so desperate for physical silver, they'd pay 30% interest just to borrow it. That's not normal market function, that's stress. That's what happens when supply is tight and demand is urgent. And here's where the paper market becomes critical. The silver market operates on 2 levels: physical silver and paper silver. Physical is coins, bars, industrial applications, tangible metal you can hold. Paper is futures contracts, ETFs, certificates, promises backed by physical metal somewhere in a vault. The problem is leverage. According to COMEX data, open interest in silver futures represents approximately 244% of vaulted silver. That means if even half the paper holders demanded physical delivery, the system would face serious stress. More claims than metal. This isn't conspiracy theory. This is basic math. The paper market is vastly larger than the physical market, and as long as nobody demands delivery, the system functions smoothly. But when physical tightness appears, when industrial users start competing with investors for available supply, the imbalance becomes visible. We've seen this movie before. In 1980, the Hunt brothers accumulated massive physical positions. The market couldn't deliver against their positions without changing the rules. So regulators changed the rules mid-game. Forced liquidation only. No new long positions. Silver crashed. But the fundamental shortage was real. The price spike to $50 was real. It took rule changes to stop it. In 2011, silver surged from $18 to $48 in less than a year. Physical premiums exploded. Retail buyers couldn't find coins. Mints ran out. The rally peaked, not because demand fell, but because prices rose so fast that selling pressure overwhelmed buying. But the structural shortage was real, and now, in 2025, we're watching the same pattern develop. Physical premiums are rising, delivery times extending, mints reporting allocation systems. The U.S. Mint announced temporary suspension of American Silver Eagle production in March 2025 due to supply chain disruptions. Translation: they can't get enough refined blanks to produce coins. The Royal Canadian Mint implemented allocation systems for dealers. You can't order what you want anymore. You get what they allow. The Perth Mint in Australia extended delivery times to 16 weeks, 4 months, for a product that used to ship in days. These aren't isolated incidents. This is systemic supply stress at the physical level. And when the physical market tightens, the paper market becomes vulnerable, because paper contracts are only as good as the physical metal backing them. And when that metal becomes scarce, confidence in paper erodes. This is the setup. Explosive industrial demand, structural supply deficits, inventory drawdowns, physical market stress, and a gold to silver ratio that just compressed from over 100 to 1 down to 64 to 1 in less than 2 years. That compression represents silver outperforming gold by nearly 2 to 1 in percentage terms. But if history is any guide, we're not done. The pattern from previous cycles is clear. When the ratio exceeds 80, silver rallies as the ratio compresses back toward average. But the rallies don't stop at average. They overshoot. In bull markets for precious metals, silver's volatility becomes an advantage, not a risk. Because while gold might double, silver often triples or quadruples during the same period. From 2002 to 2008, silver went from under $5 to over $20, a 340% gain. The ratio compressed from 80 to 1 down to around 50 to 1. From 2009 to 2011, silver surged from $9 to $48, a 391% gain. The ratio compressed from 84 to 1 down to 31 to 1. Right now, silver started 2025 at $29 per ounce. It's now trading at $67 as of mid-December 2025. That's a 131% gain year to date. Gold started the year at $2,724 and now trades near $300. That's a 65% gain. Silver has outperformed gold by a factor of 2 to 1. The ratio has compressed from over 90 to 1 at the start of the year down to 64 to 1 today. If this follows the pattern of previous cycles, compression toward 50 to 1 or lower is likely as the rally continues. And at 50 to 1 with gold holding near $4,300, silver hits $86. That's another 28% gain from current levels. If gold continues rising, which many analysts expect, the math becomes even more favorable. Bank of America raised its 12-month silver target to $65 per ounce, calling silver the tightest major metal market of 2025. UBS sees $70 potential if Federal Reserve easing accelerates. Some independent analysts project targets between $75 and $90 by end of 2026. BNP Paribas analyst Philippe Geisels told CNBC that silver could potentially reach $100 per ounce by the end of 2026. These aren't wild-eyed predictions from fringe commentators. These are major financial institutions revising their outlooks based on fundamental supply-demand imbalances. The U.S. government officially designated silver as a critical mineral in late 2025. That's significant. It means silver is now recognized as strategically important for national security and economic competitiveness. Following this designation, new investigations under Section 232 of the Trade Expansion Act have raised the possibility of tariffs on imported metals. The United States imports roughly 64% of the silver it consumes. The threat of tariffs triggered precautionary buying. Approximately 75 million ounces flowed into U.S. vaults since October. Strategic stockpiling competing with industrial buyers for limited supply. This puts a political floor under prices. Governments don't declare metals critical and then watch prices collapse. They support domestic production and secure supply chains, which means sustained higher prices to incentivize mining investment. China's role adds another layer. China is both a major consumer and a strategic player in refining and processing. While detailed export data is closely guarded, there are signs China may tighten controls over silver exports as part of broader resource nationalism. When major economies start treating commodities as strategic assets rather than purely economic goods, supply becomes less elastic and prices become less predictable. The convergence is undeniable. Record industrial demand, persistent deficits, inventory drawdowns, government recognition of strategic importance, physical supply stress, and a gold to silver ratio that historically signals major silver outperformance ahead. But let's address the skepticism. Because there are always reasons to doubt. Silver is volatile. That's true. Silver's daily price swings can be double gold's. A single Federal Reserve policy announcement can send silver up 5% one day and down 3% the next. Volatility unnerves cautious investors. But volatility cuts both ways. During rallies, silver's upside velocity exceeds gold's. The same leverage that creates downside risk creates upside opportunity. Industrial demand could weaken. If the global economy enters recession, solar installations might slow, EV sales could decline, electronics demand could soften. This is a real risk. But consider the counterfactual. Industrial demand is driven by long-term structural trends, not just economic cycles. The energy transition isn't optional. Governments have committed trillions to decarbonization. Those commitments don't disappear during recessions. They get front-loaded as stimulus. Solar installations might slow in a recession, but they won't stop. EV adoption might pause, but the regulatory mandates forcing automakers toward electrification remain in place. AI infrastructure expansion might moderate, but tech giants aren't abandoning data center buildouts. They're competing for dominance in the most important technology of the decade. Industrial demand has a floor that didn't exist in previous cycles. Substitution could reduce silver demand. This is the argument that silver can be replaced by cheaper alternatives. And for some applications, that's possible. But for high-performance applications like solar cells, advanced electronics, and EVs, there are no substitutes that match silver's conductivity without major performance trade-offs. Research continues into alternatives, but scaling those alternatives takes years. By the time substitutes become viable at scale, the current supply deficit will have already forced prices higher. Central banks don't hold silver, they hold gold. That's true. Central banks accumulated record amounts of gold in 2024 and 2025. Over 1,000 tons annually. That institutional buying supports gold prices. Silver doesn't have that backstop. But silver doesn't need it. Silver has something gold doesn't have. Industrial consumption that's growing at 8 to 15% annually in key sectors. Gold's value comes from being held. Silver's value comes from being used. Different demand drivers, but both bullish. Paper markets could suppress prices. This is the concern that futures market manipulation or concentrated short positions could prevent silver from reaching fair value. It's a legitimate concern with historical precedent. But paper markets only work when physical supply is adequate. When physical tightness appears, paper markets lose control. In 1980 and 2011, paper markets couldn't stop silver's rise. They eventually crashed the rallies, but only after prices had already surged. And each time, the fundamental shortage was real. The difference in 2025 is that the structural deficit is larger and more persistent than previous cycles. 5 consecutive years of deficits. Cumulative drawdowns approaching 820 million ounces. New supply not expected until 2027 at the earliest. The physical market is tighter than it's been in decades. And when physical markets are tight, paper markets become less relevant. So where does this leave us? Silver just outperformed gold by 2 to 1 in 2025. A 131% gain versus 65% for gold. The gold to silver ratio compressed from over 90 to 1 down to 64 to 1. That's a massive move. And based on historical patterns, it's likely just the beginning. Every time the ratio exceeded 80 in the past 50 years, silver rallied as the ratio compressed. Every time. Not most times. Every time. In 1991, 2002, 2009, and 2020, the pattern held. And each time, the rallies weren't modest. They were explosive. 340%, 391%. Gains that created generational wealth for those who recognized the pattern early. The fundamentals today are stronger than any previous cycle. Industrial demand growing at double-digit rates in multiple sectors simultaneously. Solar, EVs, AI, electronics, all accelerating. Supply in structural deficit with no quick fix. Inventories drawn down to multi-year lows. Physical market showing stress through extended delivery times, allocation systems, and rising premiums. And governments now treating silver as strategically critical. The ratio at 64 to 1 is just below the 25-year historical average of 66 to 1. But in bull markets, the ratio doesn't stop at average, it overshoots. A move to 50 to 1 implies $86 silver. A move to 35 to 1, matching 2011, implies $122 silver. These aren't fantasy numbers. These are mathematical outcomes based on historical precedent. The people who understand this pattern aren't waiting for confirmation. They're positioning now. Because by the time confirmation arrives, by the time mainstream media covers silver's rally, by the time financial advisors recommend precious metals exposure, the easy gains are gone. The move from $29 to $67 already happened. The move from 67 to 100 or beyond happens when structural tightness becomes undeniable. This isn't about predicting exact prices or timing. This is about recognizing a setup that history shows leads to explosive moves. This is about understanding that silver's dual role as monetary metal and industrial commodity creates dynamics that gold alone can't match. And this is about acknowledging that when supply deficits persist for 5 consecutive years while demand accelerates, something has to give. And what gives is price. The 80-year pattern just broke. The ratio that held above 80 for much of the past decade compressed to 64 in less than 2 years. Silver crushed gold's returns by a factor of 2 to 1. And if the historical playbook is any guide, This is chapter 3 of a story that has 7 more chapters to go. The question isn't whether silver can outperform gold. It already has. The question is whether the pattern that's held for half a century continues to hold, and whether you position yourself to benefit from it before the next phase begins, because patterns don't repeat precisely, but they rhyme. And right now, silver is rhyming with every major rally that came before. The compression from extreme ratios, the industrial demand surge, the supply deficit, the inventory drawdown, the physical market stress, the government recognition. Every element is in place. The pattern broke. And if history is any guide, what comes next is the part where silver doesn't just outperform gold, it obliterates it.